Yeah, welcome to the chat. And as we all know, in the forex market, it runs 2 4. It runs 24 hours. However, not all times are created equal. Not all times in the market are created equal. Just as we have the worst time to trade, we have the best times to trade. And just as we have the best times to trade, we have the worst times to trade. So now we are here so as we can know the worst times to trade, and so this is a useful lesson for new and experienced traders alike. Knowing when not to trade is as important as knowing when to trade. So now, when are the times that we must stay out of the market? These are kill zones. These are the times when the market maker is ready to kill. These are the times when the market maker does not care about which strategy you are employing, does not care about how good your technicals is. It does not care about the fundamentals, because at this period of time the market maker just wants to take away your money. The market maker just wants to make a bank for himself. So these times are when the first candle of the day and the first 4 hours of the Asian session, these are entirely the worst time to trade, as well as the Asian session, because you need to know that the market makers playbook, every day new targets. As you can see here on gold, let us take examples so we are going to understand clearly and further. So now, what do we see right here on gold? We can see the first candle of the day. You can go and see practically for yourself. Whenever the first candle of the day is forming, what happens? The spread widen. The spread can widen as much as 30, 50, 70 pips. Whichever pips the market maker wants to widen the spread, it widens the spread. And what happens when the spread widen? I'm going to tell you what exactly happens when the spread widen. You can see right here, price sold to this point. So let's say maybe your stop loss is here and you made an entry here, and all technicals aligned, everything is in place. Just want to explain what happens when the spread widens. You can see at this point, if the spread widens and your stop loss is here, when the spread becomes wide, your stop loss can become it and the market would chase you out. Speaking from practicals, live instances, the market can widen the stops to this zone and stop you out. You see price will drop here, and this first candle of the day, you can see right here, the spread could widen and stop you out. So price is still going in your direction, but the market maker has already widened the spread to stop you out. So now talk less of the person that takes a position in this zone, because you need to know that the market makers playbook, new day new target. So the Asian session, the first 4 hours, that is where he sets his bait, that is where he sets his trap. It's just like a fisherman doing what? Setting his trap. So you might think that, okay, the technicals has aligned, okay, I can see an engulfing candle, okay, I can see a morning star, okay, I can see an evening star, okay, I can see the EMA cross, okay, the RSI is in overbought or oversold. Whichever strategy you are employing, the first 4 hours of the day is a trap, and we are going to take vivid examples. So regardless, even if the market goes to your direction, they are just what? They are feeding you for you to be meat for them to eat later. So you can see right here, the first 4 hours, what happens later in the day, price still went above. So it is never a good time to trade. We are going to take more examples to be sure of this. First 4 hours of the day, the first candle of the day is a no-go zone. You can see the first candle of the day, what happened? This was a bearish pattern. What happened? Price went against. So you can see first 4 hours of the day is never a good decision to trade. What happens right here? You can see the first 4 hours of the day, price came to spike it. You see this is 1 2 3 4. You see price was buying and price still came to stop them out. So first 4 hours of the day, if you are trading, then the market maker is just trying to tell you that you are very impatient, and what? The market will always punish you for your impatience. You see price still came and spiked down. So the first 4 hours of the day is never a good zone to trade. You can see what happened right here. 1 2 3 4, the first 4 hours of the day. You can see price still came to spike through. Nobody is going to tell you this. However, I have nothing to lose. See, 1 2 3 4, the first 4 hours of the day is a Q zone. I don't see any reason why you should be involved in the Asian session, regardless of your time zone. Maybe you are in Asia, maybe you are in Middle East, wherever. Avoid the first 4 hours of the day. That is the market maker's trap. You can see price will spike through, and we are going to go to the bar chart to show us what happens during those first 4 hours of the day on the daily. So you can see this is the first 4 hours. You can see price still came to spike. So price would always spike the first 4 hours of the day. It is a standing rule. You can see price still came to spike. So even if price would eventually go in the intended direction, it has to come to that zone to spike. It is a cardinal rule. You can see price came to spike. Price spiked out just 4 hours before it went through. You can see first 4 hours of the day, price has to come and spike the zone. What happens here? Price came to spike. This is just on gold. You can see price came to spike and down. So even if it is the JPY pairs, the Asian pairs, AUD JPY, USD JPY, any JPY pairs, the rule remains the same. The first 4 hours of the day, price would always spike, no matter how beautiful the technicals play out. So that is a Q zone of the market. So if you understand technicals, you see that price is already giving technicals that, oh yeah, price is buying, price will buy. But what happened? Price still came to spike and spike. You can see price spiked the top, spiked the bottom. So the first candle of the day, the first 4 hours of the day, price must always punish traders that are involved in such. So now let us go to the daily, so we understand why this is happening. So now let's go to the bar chart. So you can see every day, you can see here the market sold, but every day before the market sells, when the market opens for the first 4 hours, it would buy up, it would come down, you can see, then sell. When the market open, you see the market wanted to sell, the market will open first 4 hours of the day, it will then deceive them, it is going up, then drop down, hit their stop loss. See, first 4 hours of the day, market goes up, drops down, and so here we are seeing all this with proof. Nothing is made up, it's all with proof. You can see the market bought here, but the first 4 hours of the day, when the market opened, it came down like it wanted to sell, then it bought up. You can see the market wanted to buy here, it opened, it deceived like it wanted to sell, then it went up. You can see. So before the market buys it, first it opened here in the bar chart, it went down like it wanted to sell, then it went up. You can see it opened here, went down like it wanted to sell, then went up. So the 4 hours of the day, that's the market maker's trap. And you can see the zones where we marked that price, you can see them here. You can see here it bought, it went down like it wanted to sell, it went up. So that's what happens all 4 hours of the day. Let's go to the real USD. Let's look at the daily to take more examples. So on the bar chart, you can see the market wanted to buy here, it opened first 4 hours of the day, went down like it wanted to sell, it went up. It opened, went down like it wanted to sell, it went up. So that is how the market maker moves, and that is his trap. You can see here the market wanted to sell, when it opened, it's bought up like it wanted to buy, then it sold down. So once you know all this, you won't be deceived by the market maker. You have to play more tricks to get you. You can see here the market opened, dropped like it wanted to go down, then it's bought up. So the first 4 hours of the day, and that is the market open. So on the bar chart, this is the open here, and this is the close up here. Here we have the open. As the market opened, it bought up, but what happened? It sold. So that is how the market maker moves the chart. So that is the essence of the bar chart. You are going to see the open and the close clearly. Here the market opened, bought up like it wanted to buy, then it sold down. So you can see every day, that is just the template. plan your trade your plan, and most importantly manage your risk and emotions. If you find this useful, like, share and subscribe.